It just broke, and for a moment the world felt like it held its breath. A number quietly changed on a screen in Tokyo, but the echo of that change rippled across trading floors, government offices, and living rooms far beyond Japan. The 30-year Japanese government bond yield touched 3.5%, a level many people believed they would never see in their lifetime. To some, it looked like just another data point. To others, especially those who had lived through past financial shocks, it felt like the first crack in a very old dam. For decades, Japan was the symbol of low interest rates, easy money, and stability that felt almost permanent. Investors around the world built strategies around that assumption. Banks borrowed cheaply in yen, hedge funds piled into complex trades, governments watched closely, knowing Japan's bond market was one of the largest and most influential on earth. Now, that calm image was starting to blur. The rise in the long-term yield wasn't just about Japan anymore. It was about what happens when a system that has been stretched for 30 years finally starts to push back. Somewhere in a glass tower overlooking the city, a risk manager stared at his screen, refreshing the same chart again and again. He had joined the firm long after Japan's era of zero rates began. To him, low yields were normal, almost boring, but the older traders on the floor were unusually quiet. They remembered 2008. They remembered how small moves in bond markets could trigger margin calls, forced selling, and panic that spread faster than anyone expected. This move felt different, slow, steady, and dangerous in its own way. The key word everyone kept whispering was global margin call. When yields rise, bond prices fall. When prices fall, leverage becomes a problem. Funds that borrowed cheaply now face higher costs. Positions that looked safe suddenly need more collateral. And when collateral runs short, assets get sold, not because investors want to sell, but because they have no choice. Japan's 30-year yield hitting 3.5% wasn't just a headline. It was pressure building deep inside the global financial system. Across the ocean, a pension fund manager reviewed long-term models that had not been updated in years. Those models assumed Japan would stay the same. They assumed stability, but the Bank of Japan had already begun adjusting its stance, allowing more flexibility in yields, trying to balance inflation control with economic growth. Each small policy shift had been manageable on its own. Together, they were changing the rules of the game. The question now was whether markets were ready for those new rules, or whether they were about to learn the hard way. For ordinary people, this story can feel distant and technical. Yields, bonds, and monetary policy don't usually show up in daily conversations, but the effects always do. Higher yields can mean higher borrowing costs, weaker stock markets, and pressure on currencies. They can affect mortgages, pensions, and jobs. Even if no one mentions Japan at the dinner table, this is how financial stress travels. Quietly at first, then all at once. In trading chat rooms and late-night phone calls, comparisons started flying. Some called it the end of an era. Others said it was overdue, a necessary reset after years of artificial calm. But even those who welcomed higher yields admitted the timing felt risky. The global economy was already fragile. Debt levels were high. Confidence was thin. A shock from the world's third-largest economy was the last thing anyone needed. What made this moment especially tense was how little room there seemed to be for mistakes. If yields kept rising, the Bank of Japan might have to step in more aggressively. If it didn't, markets could push even harder. Every move had consequences. Every pause carried its own risk. And unlike a sudden crash, this situation was unfolding slowly, giving people just enough time to worry, but not enough clarity to feel safe. Some investors began quietly reducing exposure, hoping to slip out before the crowd noticed. Others doubled down, convinced this was another false alarm. That split mindset is often what comes before something big. Confidence and fear sharing the same room, pretending to ignore each other. The screens kept glowing, the numbers kept ticking, and the yield stayed there, at 3.5%, like a warning light that refused to turn off. By the end of the day, news alerts had gone quiet, but the tension hadn't. The story was far from over. Was this just a temporary spike, or the beginning of a much larger shift in global finance? Would the pressure trigger forced selling across markets, or would policymakers find a way to contain it? Everyone knew the next move mattered more than the last one. And as the world waited for the next signal from Japan, one unsettling thought lingered in the air. If this is only the beginning, what breaks next? The truth was, this moment had been quietly forming for years. Long before that number flashed across the screen, Japan's bond market had been held together by trust, habit, in the belief that the Bank of Japan would always be there as the final backstop. Yield curve control had become more than a policy. It was a promise. Investors trusted that long-term interest rates would stay contained, no matter what. That trust shaped behavior across the globe. From cautious pension funds to aggressive hedge funds, chasing yield in a low-rate world. Inside Japan, the story was more complicated than the outside world often realized. Inflation, once a distant worry, had slowly crept into daily life. Grocery prices rose. Energy costs climbed. Wages tried to follow but lagged behind. Policymakers faced pressure they hadn't felt in decades. Keeping rates near zero no longer felt harmless. Every decision became a balancing act between protecting growth and acknowledging reality. When flexibility was introduced into the bond market, it was meant to ease pressure. Instead, it opened a door no one could easily close. In New York, London, and Singapore, traders who specialized in global macro strategies revisited old playbooks. Many of them had built careers betting on differences between interest rates in different countries. Japan's low yields were the foundation of countless trades. Borrow in yen, invest elsewhere, collect the spread. It worked so well for so long that few questioned it. Now, with the 30-year yield climbing, those strategies were under stress. The cost of holding positions rose quietly, day by day, like water filling a room. One portfolio manager, known for his calm during crises, sat alone late into the night, reviewing exposures line by line. He wasn't panicking, but he wasn't relaxed either. He understood how leverage worked, how quickly margin requirements could change. A move to 3.5% might not sound dramatic to the public, but in leveraged systems, small shifts can have outsized effects. He had seen it before, not in Japan, but elsewhere. Different market, same human reactions. The keyword contagion started appearing more often in internal notes. If Japanese yields kept rising, global bond markets could feel the pull. U.S. Treasuries, European debt, emerging markets, all connected by capital flows and investor psychology. Money doesn't like uncertainty. It moves fast, often without waiting for full explanations. The fear wasn't about one market collapsing overnight. It was about slow, relentless pressure, forcing decisions that no one wanted to make yet. Meanwhile, Japanese households watched the news with mixed feelings. Higher yields could eventually mean better returns on savings, something many had waited decades for. But there was also fear. Government debt levels were massive. What would higher interest costs mean for taxes, services, and future generations? The bond market wasn't just an abstract machine. It was tied to people's lives, even if the connection wasn't always obvious. In policy circles, silence became a strategy. Officials chose their words carefully, knowing that a single phrase could move markets. Every press conference was analyzed, every pause scrutinized. Was the Bank of Japan comfortable with these yields, or were they losing control? No one could say for sure, and that uncertainty fed the suspense. Markets don't need bad news to react. They only need doubt. Across social media and financial forums, opinions clashed. Some claimed this was the long-awaited normalization, proof that Japan was finally breaking free from decades of stagnation. Others warned of a debt trap, where rising yields would force painful choices. The truth, as always, was likely somewhere in between, but markets rarely wait for balanced answers. They move on emotion, momentum, and positioning. A junior analyst, new to the industry, listened carefully as veterans shared stories from past crises. He realized that charts and models could only go so far. What mattered most was how people behaved under pressure. Would they hold, hoping for intervention? Or would they rush for the exits, turning concern into reality? The yield at 3.5% became more than a number. It became a test of belief. The global margin call scenario remained theoretical, for now. No alarms were ringing publicly. No headlines screamed collapse. But behind the scenes, systems were adjusting. Risk limits tightened. Collateral demands were reviewed. Quiet emails replaced loud trades. This was the stage where outcomes are shaped before the public notices anything is wrong. As days passed, the yield refused to retreat. Each session, it stayed elevated, added weight to the question everyone was avoiding. Was the old framework finally breaking, or was this just a warning shot? The answer mattered not just for Japan, but for a world built on cheap money and borrowed time. And so the tension lingered, unresolved. The screens stayed on. The phones stayed close. Somewhere between confidence and fear, the global financial system waited for its EXT signal, knowing that once it arrived, there would be no turning back. As the days stretched on, the market stopped reacting with shock and started reacting with suspicion. That was almost more dangerous. Shock fades quickly, but suspicion lingers. Traders began to ask not what had already happened, but what was being hidden. Japan's 30-year yield holding near 3.5% suggested something deeper was shifting beneath the surface. The old assumption that the Bank of Japan could smooth every move was no longer taken for granted, and once that belief weakens, it's hard to rebuild. Inside a regional Japanese bank, a senior credit officer reviewed long-dated assets that had barely been touched in years. These bonds were considered safe, predictable, almost boring. But now their values were slipping, slowly eroding balance sheets that relied on stability. No crisis yet, just discomfort. Still, discomfort has a way of spreading. He wondered how many institutions were quietly doing the same math, reaching similar conclusions, and choosing similar conclusions. In the global hedge fund world, pressure showed up in more subtle ways. Prime brokers sent polite messages asking for updated collateral figures. Margin requirements didn't jump overnight, but they edged higher. A few basis points here, a little more cash there. For highly leveraged trades tied to the yen carry trade, those small changes mattered. Funds that had borrowed cheap yen for years now faced rising funding costs. Some adjusted positions, others hesitated, hoping the move would reverse before anyone noticed their vulnerability. The keyword, liquidity, started appearing more often in conversations. Liquidity isn't just about money being available, it's about confidence that you can exit a position when you need to. If too many people head for the door at once, even the largest markets can feel narrow. Japan's government bond market was enormous. But even enormous systems can strain when expectations changed out in Washington and Brussels. Policymakers watched closely, though publicly they downplayed the significance. No one wanted to spark panic, but privately, concerns were mounting. Rising Japanese yields could pull global capital back toward Japan, strengthening the yen and reshaping currency markets. That shift could pressure exporters elsewhere, tighten financial conditions, and complicate already fragile economic recoveries. One move, many consequences. Meanwhile, ordinary investors sensed something was off, even if they couldn't name it. Stock markets felt jumpy. Headlines used words like volatility and uncertainty more often. Retirement account balances flickered day to day. People didn't know to blame Japan's bond market, but they felt the unease. Financial stress rarely announces itself clearly. It shows up as a mood. Inside the Bank of Japan, the atmosphere was controlled but tense. Every action, even doing nothing, was now interpreted as a signal. Intervene too strongly, and critics would say policy credibility was gone. Stay hands off, and markets might push harder, testing limits that had held for decades. The institution was walking a narrow path, aware that history would judge this moment harshly or kindly, depending on what came next. A currency trader in Singapore watched the yen chart late into the night. The relationship between yields and currencies was behaving oddly, hinting at conflicting forces. Higher yields should attract capital, but fear can overpower logic. He knew that when markets start acting strangely, it often means stress is building somewhere unseen. The charts didn't lie, but they didn't tell the whole story either. Another subplot was forming in emerging markets. Many countries had borrowed in foreign currencies during the era of low global interest rates. If global yields rose in response to Japan, refinancing that debt could become harder. Investors began reassessing risk, pulling back from places once considered attractive. It wasn't dramatic yet, but the tone had shifted. Caution replaced confidence. Late one evening, a veteran economist compared notes with a younger colleague. The younger one focused on models and probabilities. The older one focused on behavior. Markets don't break when numbers change, he said quietly. They break when people realize the old rules don't apply anymore. Japan's 30-year yield was challenging a rule that had shaped global finance for a generation. Still, nothing had snapped. No forced selling cascade. No public margin call event. Just mounting pressure and unanswered questions. That was what made it so unsettling. Everyone could see the tension building, but no one knew where the weak point was. As the yield remained elevated, the silence grew louder. Each day without resolution added weight to the moment. Somewhere, someone would blink first. The only uncertainty was who and what the cost would be when they did buy now. The market felt like a room filled with people pretending not to notice the rising temperature. Everyone sensed the heat, but no one wanted to be the first to point at the thermostat. Japan's 30-year yield hovering around 3.5% had become the reference point for every conversation. It wasn't climbing fast, and that made it worse. Slow moves give time for doubt to grow, for pressure to spread quietly through balance sheets and expectations. On trading floors, screens showed steady numbers, but human behavior told a different story. Bid-ask spreads widened just a little. Trades took a few seconds longer to clear. These were small signs, almost invisible to outsiders. But to those watching closely, they meant trust was thinning. Liquidity, once taken for granted, now felt conditional. Available, but cautious. A large European bank held a meeting behind closed doors, reviewing its exposure to long-dated bonds and yen-funded positions. No alarms were raised, but contingency plans were quietly updated. If yields pushed higher, they would need to act fast. No one said the word margin call out loud, but it hung in the air. Everyone understood what it would mean if counterparties started demanding more collateral at the same time. In Tokyo, local media tried to keep the tone calm, but questions crept into coverage. Commentators debated whether this was a healthy normalization or the start of something harder to control. Older viewers remembered past financial stress, moments when reassurances came right before things unraveled. Younger viewers had never seen Japan in this position before. For them, the idea that bonds could be unstable felt unfamiliar, almost unsettling. The Bank of Japan remained measured, but markets leaned in to read between the lines. A slight change in wording, a delayed response. A carefully chosen phrase about monitoring conditions closely. Each detail was dissected, replayed, and argued over. In the absence of clear direction, speculation filled the gap. And speculation, once it takes hold, is difficult to contain. In the currency markets, volatility began to pulse rather than spike. The yen moved in short, sharp bursts, then went quiet again. That pattern suggested tension, not relief. Traders adjusted positions intraday, unwilling to carry risk overnight. Sleep became lighter. Phones stayed within reach. This was the phase where exhaustion begins to mix with anxiety, a dangerous combination. Elsewhere, equity markets struggled to find direction. Some investors rotated into defensive stocks, others stayed fully invested, convinced central banks would not allow a serious disruption. That split created choppy trading, amplifying the sense that something unresolved was approaching. The connection to Japan's bond market wasn't always obvious, but it was there, woven into expectations about rates, growth, and stability. In a modest office far from any financial center, a corporate treasurer reviewed refinancing plans for the coming year. The numbers no longer looked as friendly as they had a month ago. Rising global yields, even slightly, changed assumptions. Projects were paused, decisions delayed. This was how financial stress began to touch the real economy. Quietly, and without headlines. The idea of contagion returned, stronger than before. Analysts debated whether stress in Japan could spill into U.S. treasuries or European sovereign debt. Models showed scenarios, none of them certain, all of them uncomfortable. The global financial system was interconnected, built on layers of trust and timing. If one layer shifted too quickly, others might crack. As another trading week came to a close, the yield refused to retreat. That stubbornness became its own message. Markets had tested the waters, expecting push. It hadn't come yet. Some took that as permission to push further. Others saw it as the calm before intervention. The disagreement itself added fuel to the tension. Late one night, a senior trader sent a short message to his team. "Be ready Monday." No explanation. None was needed. Everyone knew what readiness meant in moments like this. It meant tighter risk controls, faster decisions, fewer second chances. It meant accepting that once momentum builds, events move faster than planning. As the new week approached, the feeling shifted from curiosity to anticipation. Something was coming, whether it would be a decisive move by the Bank of Japan, a sudden repricing across markets, or the first visible signs of a global margin call. No one could say, but the balance felt fragile now, like glass under pressure. The yield sat there, unchanged, daring the system to react. And as markets opened again, eyes fixed on the same number, one thought echoed across time zones. Whatever happens next will not be quiet. When markets reopened, the surprise didn't come from Tokyo at first. It came from somewhere no one was watching closely enough. During the early hours of Asian trading, a routine bond auction in another major economy drew weaker demand than expected. The yield jumped, just a little, but enough to catch attention. Suddenly, Japan's 30-year yield at 3.5% no longer looked like an isolated event. It looked like a signal. Screens across trading floors updated almost in unison. Correlations that had been stable for years began to wobble. Global bond yields moved together in a way that felt uncomfortable. Not chaotic, but coordinated. As if markets were slowly agreeing that the price of long-term money needed to be higher everywhere. That realization hit hard. If Japan was no longer the anchor, what was holding the rest of the system in place? A senior risk officer at a large U.S. fund noticed something that made him pause. Several positions, spread across different regions, were reacting to the same stress factor. They were supposed to be diversified. On paper, they still were. In reality, they were all tied to one assumption. Low, stable, long-term rates. That assumption was cracking. He ordered a deeper review, knowing full well that by the time reviews are ordered, pressure is already building. The yen began to move again, this time with less hesitation. Currency markets sensed the shift before anyone said it out loud. A stronger yen would tighten financial conditions globally, making dollar funding more expensive for some players and squeezing carry trades further. Each move fed the next. This was how feedback loops start, not with panic, but with logic that reinforces itself. In Japan, smaller financial institutions felt the strain more quickly. Their margins were thin, their flexibility limited, they relied on predictable bond prices to balance their books. A few began quietly tapping interbank markets more often, just to stay comfortable. Nothing dramatic, nothing public, but comfort was becoming a resource, not a given. Another twist came from an unexpected corner: derivatives. Long-dated interest rate swaps linked to Japanese yields started to reprice sharply. These instruments were meant to manage risk, but they can also amplify it. Margin requirements on these contracts adjusted faster than many expected. Clearinghouses sent notices. Not urgent, not alarming, but firm. The kind of message that makes desks lean forward and double-check balances. The phrase global margin call resurfaced, this time without irony. It wasn't happening yet, but the pathway was visible. Rising yields lowered collateral values. Lower collateral triggered higher margin demands. Higher demands forced asset sales. The sequence was familiar to anyone who had lived through past financial stress. The only difference was the starting point: Japan, the market that was supposed to be the most stable of all. Inside the Bank of Japan, the flow of information intensified. Data arrived faster. Calls grew more frequent. The room for error narrowed. Markets were no longer just watching policy. They were testing it. Every hour without a response invited speculation. Every rumor, no matter how thin, gained traction. Silence, once calming, now felt heavy. Elsewhere, political pressure began to surface. Rising yields meant higher future debt servicing costs, a sensitive topic in any country. Commentators asked whether central banks had waited too long to adjust policy, or whether they were now moving too slowly. The narrative was shifting from economics to accountability, and that shift carried its own risks. As the trading day wore on, one large fund made a noticeable move, trimming exposure in a way that couldn't be completely hidden. It wasn't a fire sale, but it was visible enough to be read as a signal. Others noticed, some followed quietly. Momentum began to build, not from fear, but from imitation. In markets, imitation can be just as powerful. By the close, volatility had risen across assets. Nothing had broken, but nothing felt solid either. The system was under strain from multiple directions now. Bonds, currencies, derivatives, confidence. Japan's 30-year yield remained the reference point, the number everyone circled back to, the reminder of how this all started. As night fell across major financial centers, one question dominated private conversations. If the next move comes, will it be controlled, or will it come from the market itself? No one had the answer yet. But with every passing hour, the space between stability and disruption felt thinner. Like ice that creaks just before it gives way, the moment everyone had been bracing for didn't arrive with a crash. It arrived with an announcement that was calm, deliberate, and timed almost too perfectly. Before markets could fully digest the growing stress, the Bank of Japan stepped forward. Not with panic, not with emergency language, but with a clear signal that it was ready to act as a stabilizing force. Bond buying operations were adjusted. Communication was sharpened. The message was simple. The situation was being managed. Markets reacted instantly. Japan's 30-year yield pulled back from its peak. Not dramatically, but enough to release some of the pressure. That small retreat mattered. It told investors that there was still a backstop, still a hand on the wheel. The feared global margin call cascade didn't materialize. Collateral values stabilized. Margin demands stopped rising. The forced selling many had dreaded never fully ignited. Relief spread across trading floors in waves. Phones buzzed with short messages, the kind that say more by what they don't include. We're okay, for now. Traders leaned back in their chairs for the first time in days. Risk officers updated dashboards, watching red turn to yellow. The system had bent, but it hadn't broken. Currency markets followed. The yen eased, reducing pressure on carry trades and cross-border funding. Equity markets found their footing, clawing back losses as confidence returned. Cautiously, headlines shifted tone, using words like contained and orderly. Commentators spoke about policy, credibility, and decisive action. On the surface, the crisis seemed to be passing. Inside financial institutions, meetings that had been tense turned practical. Exposure was reassessed, but not in a rush. Lessons were noted. Assumptions were questioned. Japan's bond market had delivered a warning shot, and it had been heard. The idea that ultra-low yields were permanent was gone now. That chapter had quietly closed. For households and businesses, the immediate shock faded into the background. Borrowing plans resumed. Markets stabilized. Life moved on, as it often does after moments of financial stress. To many, this would be remembered as just another scare. Another headline that didn't turn into disaster, but beneath that sense of resolution, something else had changed. In the days that followed, analysts began to notice a subtle shift. Even after intervention, yields did not return to their old lows. The 30-year yield settled at a higher range than before, stable but elevated. The message was quiet but clear. Control had been reasserted, but the old normal was not coming back. That realization was the true climax of the story, though few recognized it immediately. The conflict wasn't just about a spike to 3.5% or the threat of a global margin call. It was about the end of certainty. Central banks could still guide markets, but they could no longer freeze them in time. The unexpected twist came not from Japan, but from investors themselves. Instead of rushing back into the same old trades, many chose caution. Yen-funded strategies were scaled down. Long-dated leverage was reduced. Capital began seeking flexibility over yield. It wasn't fear-driven. It was adaptive. The system was learning. In policy circles, the tone shifted as well. Officials spoke more openly about trade-offs, about limits, about gradual change rather than permanent control. The language of certainty gave way to the language of management. That shift, subtle as it was, marked a turning point. The global financial system had avoided a dramatic collapse, but it had crossed a line it couldn't uncross. Japan's bond market, once the symbol of eternal stability, had reminded everyone that even the strongest anchors can move. The danger hadn't been the rise in yields alone. It had been the belief that such a rise was impossible. As markets settled, one final thought lingered, quietly unsettling. If this much tension could build from a controlled adjustment, what would happen when the next shock wasn't planned, or measured, or managed in advance? The screens dimmed. The numbers held steady. The crisis, officially, was over. But the story wasn't. It had simply entered its next phase, one where the rules were less certain, the margins thinner, and the stakes higher than before. In the weeks that followed, the noise slowly faded, replaced by something quieter but more meaningful: reflection. Markets had stepped back from the edge, and the world had avoided the kind of headline-grabbing crisis people fear most. There were no emergency summits, no dramatic collapses, no sudden freezes. Instead, there was a collective exhale. But beneath that calm, lessons were settling in. Japan's bond market found a new rhythm. The 30-year yield no longer hovered at shocking levels. Yet it didn't retreat to the depths of the past either. It moved within a higher range, watched closely, but no longer feared. Investors adjusted expectations. Policymakers adjusted language. The idea that interest rates could be held down forever quietly disappeared, not with an announcement, but with acceptance. For the Bank of Japan, the episode became a turning point. Its actions had shown credibility still mattered, but so did flexibility. Control was no longer about freezing markets in place. It was about guiding them through change. Internally, officials acknowledged what had once been unspoken. The era of absolute certainty was over, replaced by careful management of risk, inflation, and confidence. Global investors carried the experience with them. Strategies that depended on endless cheap money were rewritten or abandoned. The yen carry trade didn't vanish, but it became more cautious, less crowded. Leverage was treated with more respect. Risk models were updated, not just with new numbers, but with new assumptions. Stability, many realized, is not the absence of movement. It's the ability to adapt when movement comes. The feared global margin call never arrived, but it left behind a warning. Margin stress doesn't always announce itself loudly. It builds quietly, through small changes in yields, collateral values, and behavior. The story of Japan's 30-year yield reaching 3.5% became a case study, shared in meetings and classrooms. A reminder of how interconnected the global financial system truly is. Banks that had reviewed their exposures during the tension emerged stronger for it. They didn't celebrate, but they were better prepared. Liquidity plans were refined. Communication lines were tested and improved. What had felt like pressure turned into preparation. The discomfort had served a purpose. For households and businesses, the impact was subtle but real. Borrowing costs were slightly higher, and savings finally earned a bit more. Conversations about money felt different, less certain, more thoughtful. People didn't talk about yields at the dinner table, but they felt the shift in decisions, in planning, in caution. Markets, as always, moved on to the next story. But this one lingered in the background. Whenever volatility picked up, someone would mention Japan. Whenever long-term rates moved unexpectedly, eyes would glance back to that moment when an old assumption cracked. The biggest takeaway wasn't about bonds or central banks alone. It was about humility. Financial systems are built by people, and people rely on stories to make sense of risk. For years, the story was that Japan's low yields were permanent. When that story changed, even slightly, the reaction revealed how much the world had leaned on it. In the end, nothing dramatic broke. And that was the point. The most important shifts often happen without spectacle. They reshape behavior quietly, influencing decisions long after headlines fade. Japan's yield move didn't end the global financial system, but it ended an illusion. As time passed, the episode found its place in history. Not as a crisis, but as a warning shot that arrived early enough to matter. It reminded policymakers to communicate clearly, investors to respect risk, and institutions to prepare for change rather than deny it. The world kept turning. Markets opened and closed. Numbers rose and fell. But something fundamental had been reset. Stability was no longer defined by stillness, but by resilience. And that may have been the most valuable outcome of all.